Welcome to our deep dive on mastering the backdoor Roth for high earners. In this video, we will show you exactly why instant conversion is non-negotiable, how to avoid the taxable gains trap, and how to handle broker matches without derailing your strategy. Let's transition smoothly into the agenda to see what's coming up. Here is the agenda. First, we'll establish context and who this strategy is for. Next, we'll cover an important disclaimer. Then, we'll explain the backdoor Roth in 60 seconds, followed by the reason speed matters and the specifics of the taxable gains trap. After that, we'll walk through the exact step-by-step flow. We'll also cover how to handle broker incentives and matches, the paperwork and tax forms you must file, common pitfalls with fixes, 2 short quizzes, and finally we'll wrap with key takeaways and a summary. Before we proceed, please note that this content is for educational purposes only and does not constitute tax, legal, or investment advice. Individual circumstances vary. Consult a qualified CPA or financial advisor. Additionally, this video focuses on the backdoor Roth strategy for high earners who are ineligible for direct Roth IRA contributions. Rules can change and details vary by custodian. Now, with the disclaimer out of the way, let's move into who this strategy is designed for. This strategy is primarily for high-income investors who are barred from direct Roth IRA contributions due to income limits. If you want a Roth IRA's tax-free growth and tax-free qualified withdrawals but can't contribute directly, the backdoor process is your path. With that foundation, let's quickly summarize how the backdoor Roth actually works. Here's the backdoor Roth distilled. First, contribute non-deductible cash to a traditional IRA. Next, let the funds settle while staying in cash to avoid gains inside the traditional IRA. Then, convert to a Roth IRA as soon as settlement completes. After that, invest only once the money is inside the Roth. Finally, if a broker match posts later into the traditional IRA, convert that match separately. This keeps taxes clean and maximizes Roth time in the market. Now let's explain why speed matters so much. The timing is critical. Any gains that occur inside the traditional IRA before you convert are taxable income when you complete the conversion. To minimize tax, keep your contribution in cash and avoid investing until after conversion. Then, invest once the funds are inside the Roth IRA, where growth is tax-free. In short, convert first and only then invest. With the rationale clear, let's move into the exact step-by-step sequence to follow. Follow these steps in order. First, ensure you have both a traditional IRA and a Roth IRA open. Second, contribute non-deductible cash to the traditional IRA. Third, wait for the cash to settle and do not invest within the traditional IRA. Fourth, convert the full non-deductible amount to the Roth IRA immediately after settlement. Fifth, once the money is in the Roth, allocate to your chosen investments. Sixth, if a broker match later posts to the traditional IRA, perform a separate conversion for that match. Seventh, keep records and plan to file Form 8606 to report the non-deductible contribution and conversion. Next, we'll visualize this with a diagram to cement the flow. This flowchart depicts the complete process. It starts with a non-deductible cash contribution to a traditional IRA. After funds settle, the next step is an immediate conversion to a Roth IRA. Only after the funds land in the Roth do you invest. Meanwhile, if a broker match later arrives in the traditional IRA, you perform a separate conversion of that match, which will be taxable on conversion. There is also a checkpoint calling out the need to review existing pre-tax IRA balances because of the pro rata rule. Existing pre-tax IRA money can make a portion of your conversion taxable regardless of timing. With this overview, let's document the tax forms and record-keeping you'll need. On the paperwork front, you will use Form 8606 to report non-deductible contributions to traditional IRAs and to report conversions to Roth IRAs. Your custodian will furnish Form 1099-R for the conversion, and you must distinguish taxable from non-taxable portions. Maintain a running log of your after-tax basis in traditional IRAs, as that basis carries forward each year. Note that trustee-to-trustee conversions are not subject to the 1 rollover per year limitation, which applies to indirect rollovers. Critically, the pro rata rule aggregates your traditional, SEP, and simple IRA pre-tax balances, potentially making part of any conversion taxable. Many investors mitigate this by rolling pre-tax IRA balances into an employer 401k before conducting the backdoor Roth. To help you stay organized, use the checklist provided. Next, let's contrast what to do and what to avoid. On the left, focus on best practices. Contribute non-deductible cash, keep it in cash until conversion, convert immediately after settlement, invest only inside the Roth, handle any later broker match with a separate conversion, and file Form 8606 to maintain accurate basis. On the right, avoid pitfalls. Do not invest while funds are still in the traditional IRA. Do not delay conversion just to wait for a broker match. Do not overlook the pro rata rule and aggregated IRA balances. Do not miss contribution limits or deadlines, and do not assume the custodian will manage or optimize your tax reporting. With the principles clear, let's tackle broker incentives in detail. Broker matches, such as 3% incentives, are typically treated as pre-tax funds and will be deposited into your traditional IRA. Do not delay your conversion waiting for that match. Convert your original non-deductible contribution immediately. When the match posts later, execute a second, separate conversion. That smaller match amount will be taxable upon conversion, but the key is that your main contribution enjoys Roth tax-free growth as soon as possible. As we continue, let's test your understanding with a quick quiz. Quiz time. The question is, when should you invest the money related to a backdoor Roth contribution? Option A. Before converting, invest inside the traditional IRA. Option B. After converting, invest inside the Roth IRA. Option C. It does not matter where you invest. Option D. Wait until the broker match arrives, then invest. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is B. You invest after conversion so that the growth occurs inside the Roth, avoiding taxable gains that would arise if you invested while the funds were still inside the traditional IRA. This keeps your tax reporting simpler and your outcomes more efficient. Next, let's take another quick quiz on broker matches. Here is the second question. Your broker offers a 3% match on IRA deposits that posts later to your traditional IRA. What should you do with your original non-deductible contribution? Option A. Wait for the match before converting anything. Option B. Convert the original contribution immediately and convert the match later separately. Option C. Invest everything in the traditional IRA to earn gains first. Option D. Skip conversion entirely. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is B. Convert the original non-deductible contribution immediately. When the pre-tax match arrives in the traditional IRA, convert it separately. The match portion will be taxable upon conversion, but this approach ensures your principal moves into the Roth quickly, where it can grow tax-free. Now, let's reinforce the most important rules with a concise table of pitfalls and fixes. This table summarizes common pitfalls and their remedies. Investing before conversion risks taxable gains. Fix this by holding in cash, converting immediately, then investing in the Roth. Waiting for a broker match delays compounding. Convert the principal immediately and the match separately later. Ignoring the pro rata rule can cause an unexpected taxable portion. Mitigate by rolling pre-tax IRA balances into an employer 401k if available before converting. Poor records or Form 8606 mistakes lead to basis and tax mismatches. Keep 1099-R forms and file Form 8606 accurately. Finally, prefer trustee-to-trustee movements to avoid rollover limitations. Next, we will highlight the key takeaways you should remember. These are the key takeaways. Convert first, and then invest inside the Roth. Keep the contribution in cash until conversion to avoid taxable gains. Handle broker matches with a separate conversion as soon as they post. Be mindful of the pro rata rule and maintain accurate basis tracking using Form 8606. Overall, move quickly and keep clean records to simplify taxes and maximize tax-free growth. Before we conclude, let's summarize everything concisely. To summarize, High earners can unlock Roth benefits via the back door by contributing non-deductible cash to a traditional IRA and converting immediately. Avoid the taxable gains trap by holding funds in cash until conversion and investing only after the funds are in the Roth. If a broker match later posts to the traditional IRA, convert it separately and expect that portion to be taxable upon conversion. File Form 8606. Keep your 1099-Rs and statements, and plan around the pro rata rule, which may involve rolling pre-tax IRA balances into a 401k. Finally, let's close with a friendly request. Thanks for watching. If this helped, please like the video, share it with someone who needs a clean backdoor Roth game plan, and subscribe for more actionable, step-by-step guidance. Drop your questions, experiences, or tips in the comments. What tripped you up the first time? Timing, paperwork, or the pro rata rule? Let's learn together.